Thanks for joining us for today's episode of The Capitalist Investor. You got Mark and Diamond Hands D.
What's up, Mark?
What's up, brother man?
Not too much, man.
All right, man. So we're finishing up with the second part of a two-part show, which is Biden's 7 ways he's going to tax the rich and the not so rich. Right, or at least what his plan looks like for the rich and the not so rich. So we knocked out the first 2 last week. We digressed quite a bit talking about the WWE wrestling, which was fun. We're not going to do that again this week. So we talked about the first 2. So let me just hit on the first 2 real quick. So the first one is he's going to raise the top ordinary income tax rate from, I believe, 37 to 39.6.
Yep.
Second one is he wants to raise the capital gains tax from 20% to 43.4%.
Right.
Which would be brutal. All right, number 3, he wants to eliminate the step up in basis on inherited property.
Right. You know, I think this one is one that is kind of getting overlooked, but is a pretty big deal, in my opinion, especially for estate planning purposes. It's a major change. And that is something, you know, honestly, that's probably been on the Democrats' wish list for quite some time. And we'll talk about if we think if it has legs or not and if it's going to pass as proposed here. But eliminating the step up in basis on inherited property. So real quick, you know, so let's say it's me, right? And I got $1 million saved in my non-qualified account, so like my brokerage account. Yep. So I've been, you know, buying stocks over a period of time, and let's say the money I put in there was $500,000.
Yep.
All right. So I've essentially made $500,000 over my lifetime in that non-qualified account. Now, let's say I pass away and that $1 million goes to my daughter. Okay.
Yep.
Right now, she would get that whole $1 million. All right.
Yeah.
She would receive a step up in basis, meaning her new basis would be the value of those assets on the day that I passed away. Okay.
Right.
Now, under this proposed rule, this new tax law, basically, under that same scenario, my daughter would now have $500,000 worth of long-term capital gains that she would need to pay taxes on.
Yep.
It's pretty unclear exactly how that's going to go down, but kind of what I've read so far would be essentially that's due on my passing.
Yep.
That's kind of the thought that what would happen. So, you know, either my daughter could, you know, stroke a check for, right now, we'll call it 20% of 500,000, 23.8 if we're getting real technical about it. But, you know, as we talked about last show, we may see a rise in long-term capital gains tax rates. We may even see it get eliminated altogether eventually. Yeah. But if that number was over $1 million, as is proposed right now, that tax could be as high as 43.4%.
Yep.
So obviously a major difference in assets that get passed down.
So Biden has always been a believer in carryover basis, which is what it's called when you eliminate the step up at death.
Right.
He's also a believer right now in not just carryover basis, but in taxing unrealized gains at death. Mm-hmm. Like you got to pay the tax right then and there.
Right.
You don't just get to carry over the lower basis and eventually pay him. He wants it right now.
Right.
Now, currently, I believe the estate tax exemption is about $11.5 million for a couple.
Yep.
And the highest estate tax federal rate's like 40% above and beyond that. Mm-hmm. If he does this, if he eliminates the step up in basis, from what I can tell, D, this is going to hit middle America too. Mm-hmm. Right now, estate tax just hits people $11.5 million or greater than $11.5 million.
Right.
Right. So this is going to dip into middle America. I don't think this is going to happen. Biden's been trying to get this done for 40 years, and he's been unsuccessful. I think what's more likely is a higher estate tax. So maybe the 40 goes to 50, like it used to be. And maybe the 11.5 comes down to like 8. I think that's what's going to happen. The exemption's going to come down. The estate tax is going to go up. I don't think there's going to be and elimination of the step up in basis.
Yep.
That is going to really irritate his voter base.
Absolutely, no doubt about it. It's as it's proposed. It's a pretty massive change. And again, you know, we talked about it a little bit last show. It's really difficult to penalize people who have been planning for things one way and then just completely ripping the rug out from underneath them and changing the tax code really drastically.
So, I mean, you talked about your savings in your non-qualified account going to your kids. Which color does California vote?
Usually blue.
Okay, they vote blue. Where do you think most of their wealth is?
Like how they're getting it?
No, where do you think on their balance sheet?
Okay.
Where's the biggest chunk of a Californian's wealth?
That is a great point. So I would probably say non-qualified assets.
Specifically their real estate.
Yep.
Okay. Specifically their house. Now, they bought this house 30 years ago for $250 grand. That house is worth $2.5 million today.
Right.
Okay. They pass away. Their children inherit it. How do you pay that tax on death? With your situation, your kids could liquidate your account.
Right.
What happens for the Californians who all voted blue?
They're going to have to come up with that cash.
They got to come up with the cash. I don't think this happens for that reason.
I'm with
Next.
you there.
All right. Number 4, tax carried interest as ordinary income. All right. I didn't hear too much about this, D. What's going on here?
So, you know, we talked a little bit about it last time. Biden's ultimate goal is to try to eliminate the tax loopholes, if you will.
Yeah.
This is a pretty small loophole, honestly, if you ask me. So it's carried interest rules is taxed at the favorable rate, and he's just basically proposing to bring that up to ordinary income levels.
So it's an accounting tactic that does this apply, you think, to this has to apply to dividends, right?
Yes.
So, I mean, dividends are going to be taxed at that higher capital gains rate.
Correct. Yeah.
Okay.
That's what it's coming down to. And that's going to have a lot of impact on like different funds, mutual funds, how all that works as well.
This is going to have an impact on just the average Joe on Main Street. Joe and Sue, who worked for 30 or 40 years, they've been diligent enough to accumulate $1 million. They built a nice all-weather portfolio out of dividend-paying stocks, and there's some capital gains involved because they've held those stocks for a long time. They've been buy and hold investors, and now suddenly, every which way, they're going to take it on the chin.
Right, which is frankly kind of annoying, especially in the business that we're in. Not everyone who owns a stock or who owns a fund is fabulously wealthy.
Yeah.
You know,
Yep.
And I think that's really what is trying to be portrayed out there. This is, you know, a quote unquote loophole for fund managers who allow, you know, essentially their clients to get a favorable tax treatment on money that they earn.
Yep.
You know, closing that down to get more taxes in the hopper, is it ultimately positively affecting your overall, you know, the country overall, I should say, right?
Yep.
Is it going to have a positive effect for most people? And I would say no.
Yeah.
You know, it's this rule is aimed at those people who, you know, they think are just cashing out by taking advantage of a rule, and they don't need the advantage because they're, like I said, fabulously wealthy.
Yep.
That is not the case. That is not what's going on here for a lot of people.
Yep. All right, next up, number 5, curtail like-kind exchanges. So this is big in real estate, 1031 exchanges.
Yep.
Right?
So go ahead.
So the basic deal is, let's look at this on a micro level. That person in California bought the house for $250,000. Now it's worth $2.5 million. That person could sell that home and then buy a new house elsewhere and not have to pay any capital gains,
right?
Because it's a like-kind exchange. It looks like under this rule, any gains larger than 500 grand would now be taxed.
Right. No longer qualify.
Yeah.
What do you think that's going to do to the real estate market?
That is going to crush the real estate market. Now, here's my real issue. So that's an issue as it relates to all of the people, you know, in states like California where they voted blue. Like, it's going to really hurt them.
Right.
Our houses haven't appreciated as much here. Like, they just haven't, man. Like, so I feel bad for the people of California, you know, but you know, this also is the way they voted, right? So, you know, sometimes you need to actually make sure you're educated on what you're voting for. Here's where this really sucks, dude. For all of the commercial building owners, the people who own the apartment complexes that have allowed people to stay rent-free because of the eviction moratorium, they've gotten the shaft, and now you're going to shaft them again?
Exactly.
Do you know what that's going to do to rents? If you sell an apartment complex and buy a new one and you just had to take it on the chin, you're going to get compensated in return. You're going to hike up rents on people. And
who does that affect?
You're hurting lower America, middle America. Like, what are you doing? Dude, sometimes when people look at these tax proposals, they're so short-sighted. They don't see how it affects everyone.
Right.
So I don't think that one's going to happen.
Yeah, that would be really unlikely, especially like you said for the California voters.
Dude, everyone on the West Coast, they've realized, and New York, there's so much real estate appreciation built in. I find it hard to believe that some of these go through on them.
Yep, for sure. Most of what I've learned about 1031 exchanges, too, I saw on $1 Million Listing New York and $1 Million Listing LA.
There you go. There you go.
So, yeah, that's going to be a tough one to get through.
All right, extending the business loss limitation rule. So individuals operating a trade or business can't deduct losses exceeding $250,000 or $500,000 if you're a joint filer on Schedule C. You can carry them forward to later tax years. That is set to expire in 2027. President Biden's plan calls for the business loss limitation rule to be made permanent. Okay. Is there a way around that? I mean, what if you, rather than ran your business taxes through a Schedule C, I wonder how this would look if you were an S corp.
Yeah, that's a good point.
I don't know off the top of my head.
I don't either.
You know, all right, so he's going to limit the losses. All right. I mean, I understand limiting losses. I also understand the flip side where if a business owner lost money, like, you deserve to be able to pocket those to offset your future income.
Right.
You know, that is a big issue.
You know, this one is another quote unquote loophole that he's going after, which probably has more, political run than actual benefit to the IRS and their revenue that they're bringing in. So, this one probably we don't need to talk about it too much more, but, just trying to close some of the loopholes that the quote unquote rich take advantage of.
Yep.
But that's
already in place right now.
Right.
So that's really just an extenuation or continuation of what's already in place.
Yep.
Makes it permanent. Number 7, they're going to spend $700 billion hunting people down. Yeah. So number 7, increasing enforcement activities.
Yeah, this one caught my attention quite honestly. Oh. So they're going to, they're proposing to, spend more money, go figure, by giving the IRS an extra $80 billion over a 10-year period to basically audit more people. That's
$700 billion, right? Oh no, they're looking to raise $700 billion in revenue. Okay, I thought they were spending $700 billion. All right, I mean that makes it a little better, even though it's not better. So all right, so they're going to spend $80 billion over 10 years to hunt people down.
Yep.
I heard one of the things they're targeting is crypto.
Yeah, for sure.
Obviously tax evasion and stuff like that. But here's my issue here, dude. our tax code is so complicated.
Right.
There have been people arguing for years and years and years about just simplifying it. If you just simplify the freaking thing, like, you wouldn't have a lot of these loopholes and people taking advantages of certain things they shouldn't be doing and then having to hunt them down. Do you know how expensive an audit is? It's got to be expensive for the IRS to do it. But imagine, like, just a human being, a tax-paying citizen getting audited, and the amount of time that you need to peel away from what you do for a living to gather up and make sure you have organized all of the proper documentation to fight that audit. That sucks, dude.
For sure.
I mean, that's talk about taking your eye off the ball.
Yep.
That is forcing people to take their eye off the ball. Stop doing what they do best. I think the solution to this is simplify the damn thing. Like, flat tax. I've read, plenty of Milton Friedman books. I love his stuff. And he's talked about, having a tax rate where there's a negative tax, where people who are in lower income ranges, they get paid money by the government only if they go to work.
Right.
Like, it's a negative tax as opposed to don't go to work at all and we will pay you to stay at home. So, dude, I am all for overhauling this tax code. Like, do you really need all of these IRS agents running around hunting people down? Or can you just make it simple and easy and impossible to beat?
Yeah, for sure. I think that is an excellent point, and it gets talked about a little bit on TV. But if you invent new rules that are going to tax the rich, guess what the rich are going to do? They're going to figure out ways to beat the new system.
Yeah.
So if you raise the taxes on the rich, yeah, you might get a little bit more revenue. Maybe revenue goes down. We talked about that a little bit on some of these proposals. But who you're really paying off is the CPAs and the lawyers who are coming up with new ways to basically avoid paying taxes and to do it legally. I mean, back in the day, it was like the AB trust.
Yeah.
Remember those things when the
marital exemption or spousal, whatever it was.
So
yeah.
Back before we had $12 million estate tax exemption, an AB trust would be kind of how you could get some more exemption on your estate. So that's a great point. Probably a good way to end it here. If you're going to raise taxes, do it in a manner which is actually going to be beneficial.
Yeah.
To everyone, right? I think a great example is on the Trump tax cuts where the SALT, the state and local taxes, right?
Yeah.
All these people in the blue states were saying, hey, I want to pay, we should pay more taxes. We should pay more taxes. When they actually have to pay more taxes, everyone freaked out.
Yeah.
It's
wild, man.
So, let's get these rules simple and hopefully get this budget more balanced than it is right now, as opposed to this deficit spending that's been going on for a long time now.
It's crazy, dude. All right, man, that wraps up our part 2 of our 7 ways Biden plans to tax the rich and maybe some not so rich people as well. Hope you enjoyed this 2-part series. As always, shoot us a question over at info@swpconnect.com. Hit the subscribe button. Tell your friends about us. Write a review. Shoot us a screenshot. We'll send you some swag. As always, thanks for joining, and we'll talk to you next week.
The opinions expressed in the podcast are for general informational purposes only and are not intended to provide specific advice or recommendations for any investment, legal, financial, or tax strategy. It is only intended to provide education about the financial industry. Please consult a qualified professional about your individual needs.